The U.S. economy might not be in a recession yet, but the R word is definitely haunting Wall Street. The forecast is getting cloudier by the day. Goldman Sachs recently bumped its recession odds to 30%, while the folks at Moody's are even more bearish, placing the chances of a downturn at a coin flip 49% over the next year. When the market starts sweating, it's easy to catch the fever. But before you panic sell or bury your cash in the backyard, it's worth checking the notes of a man who has successfully navigated every economic storm since the Truman administration. Warren Buffett didn't become the Oracle of Omaha by following the herd. Here is his golden rule for staying sharp when the economy gets dull. The silver lining: why market slumps are a gift. In 2008, while the S&P 500 was hemorrhaging nearly half its value and the Great Recession was in full swing, Warren Buffett didn't retreat. Instead, he took to the New York Times to offer a much-needed reality check for panicked investors. In that op-ed, he dropped what has since become his most iconic mantra: a simple rule dictates my buying: be fearful when others are greedy and be greedy when others are fearful. Bad news equal big discounts. Buffett's logic is refreshingly simple: volatility isn't the enemy, it's the opportunity. He pointed out that despite a century of wars, depressions, and panics, the market has always moved upward in the long run. If you have the stomach to buy when the headlines are terrifying, you're essentially buying a slice of America at a massive discount. As the Oracle puts it, bad news is an investor's best friend. It allows you to build a future for pennies on the dollar while everyone else is running for the exits. Why a downturn is actually a flash sale. If a recession hits, and that remains a significant if, stock prices will likely take a hit. While that sounds intimidating, Buffett views it differently. It's a lucrative window to load up on elite companies at a fraction of their usual cost. The cost of success. The market has been on a tear lately, hitting record high after record high. While that's a win for long-term holders, it makes entering the market expensive. Take the Vanguard S&P 500 ETF VU as a prime example. 5 years ago, you could snag a share for roughly $359. And today, that same share will cost you over $600. For investors on a budget, these all-time high prices can feel like a barrier to entry. A recession flips the script, transforming prohibitively expensive stocks into steeply discounted opportunities. Don't wait for the perfect storm. Does this mean you should sit on the sidelines waiting for a crash? Not necessarily. There is no guarantee a recession will strike in 2026. If you wait for bottom that never comes, you lose the most valuable asset an investor has: time. Compound interest needs time to work its magic, and every month you spend waiting is a month of missed growth. The bottom line: don't let falling prices scare you out of the market. If you retreat when things get shaky, you aren't just avoiding risk, you're missing out on the biggest wealth-building opportunities of the decade.